today's episode, we are talking personal finance at any age. We are going to look at a couple personas at various life stages, understand how much they have to invest, and I will give recommendations for what I think they should do and how they should invest their money. So welcome back to Stately Investing. And if you want a channel that is going to help you speed up your journey to financial freedom through dividend growth investing, Stately Investing is the place for you. So hit that subscribe or like button below and let's get started. All right, everybody. So let's meet our three investors. We have younger Yuri, middle-aged Martha, and older Oliver. And all three of them are meant to represent the typical investor at their life stages. So we're going to look at their age, a little bit of their background, how much they have to invest, and the strategy behind their investments and what I think they should do with that money. So this is hopefully going to give you guys some ideas out there if you're just starting out as an investor, or you have a chunk of money that you want to invest, depending on your life stage and what your strategies are. And you can pick and choose from each of these personas, given your own personal finances, right? Personal finance really means personal. So don't just listen to what I have to say. I'm not a financial advisor. I'm just here to share my experiences with you. But please, pay attention to each one of these personas and see what fits for you. And we'll go through them step by step. So first up is younger Yuri. So younger Yuri has found his first job in his desired career field. He's been working, a few other jobs that he didn't really like, but they kind of paid the bills. So Yuri's 25 years old. He does have health insurance, and he's getting his first 401k match from his company. He lives with one roommate, and his income is $45,000. So he saved up a bit of a little tiny nest egg of around $5,000. He's interested in investing, but he wasn't sure if he should be investing that money slowly. So he's kind of saved all of this money up, and now he thinks is the right time to invest. So that's why we call younger Yuri itching to earn. He is looking to make his money work for him, which we know on this channel we all love. And so let's outline what his strategy is. And these are percentages that I've dedicated to each one of the personas, but you can adjust these as necessary for your own personal situation. So I think for younger Yuri, right, he's very young. It's good that he's getting into the investment arena at this age. And I think his strategy should be more focused on, things that you can do when you're younger that you might not be able to do when you get a little older. So potentially, taking on a bigger portion of risk and really focusing on growth and compounding, right? So growth, we're looking at 25% of his portfolio should be allocated to that. Compounding is 50%. And compounding is really what aligns with our channel, right? So here on Stately Investing, we do a lot of talk of dividend investing. And so compounding really takes advantage of, or dividends really take advantage of compounding. So because Yuri is so young, we can see a huge benefit from if he just starts investing at this age and letting his money work for him. Lastly, we'll look at risks and big bets. So this is around 25%. And I think when you're younger, you can have a higher percentage of your portfolio on big bets. So if we look at my recommendations for Yuri, and most of these recommendations you guys today will be ETFs. I think you can pick out and choose individual stocks, even if you go into these ETFs and see what they're actually using, if you like or dislike particular stocks. But for the purposes of the video, I thought it would be easier just to talk mostly about ETFs that I personally think are, that I've done the research on and I think are suited for these different personas. So in this case, we're looking at the Vanguard Index Growth ETF, so VUG. This index fund has a lot of technology. And, again, this is the main portion of where his growth should be coming from. I allocated this at 25%. So all of his growth proportion is in this one ETF. VUG is very good at picking stocks, not only that have good momentum, but are in growing industries and have a potential big upside. The next few picks here are all in that compounding bucket. So the VYM, which is the high dividend yield Vanguard fund, ProShares, the S&P 500 Dividend Aristocrats ETF, so Noble. So these are the Aristocrat Nobles, Dividend Aristocrat Nobles. And then Vanguard Specialized Funds Dividend Appreciation ETF. So this is VIG. This is a Vanguard dividend growth fund, which is, my primary investment strategy. And so that is a ETF that I particularly enjoy. And then the Vanguard S&P 500 index, so VOO. So I think all of those buckets fit into the compounding. All of those stocks fit into the compounding bucket. So I think all of those are a good fit. I've allocated more towards the high yield, again, because he's young, and a little bit more towards the aristocrats because we know that kind of counterbalances, and that we know that they're going to consistently pay out dividends until he retires, right? Like there's very little chance of those companies going out of business or cutting their dividend, and so it really takes advantage of compounding when you invest in those companies. As far as the big bets and the risk areas, I picked individual tech stocks that I thought had potential for growth. Most of you guys will be familiar with these. So Amazon, Shopify, Apple, and Tesla. I think, e-commerce is obviously a growing industry. Amazon is the biggest player in that, but Shopify is a up and coming competitor and really just powering a lot of sites, right? So their model's a little different than Amazon. They power more of the kind of scrappy startup e-commerce sites around the industry. And obviously Apple and Tesla, both of which had their stock splits today, are wise investments in the technology space, but potentially risky, right? So like all of these technology stocks, who knows if the companies will still exist when Yuri turns, let's say 65 or 75, whenever he wants to retire. But I think potentially these are big bets that you could start on now and put in a small portion of money and see that money really grow and explode without having to do a lot of continued investment in the future. So if we look at some of the notes for younger Yuri and things that you want to either avoid or we should talk about before he invests. So this all assumes that he has no debt, right? And so a lot of 25-year-olds actually have quite a bit of debt still, potentially personal loans or school loans, credit card debt, those kind of things. And the note here is that any debt with interest above 4 to 5% should be paid back as soon as possible. I think, once you get below 4 to 5%, you're touching on like inflation levels, and potentially you would be out earning this if you were investing. So I think that's right around the mark where you should make sure you are paying down that debt as soon as possible before you really invest any additional money into the stock market. Additionally, you want to avoid big ticket expenses. So at this age, there's the tendency to want to spend money on things like high rent. So, you don't want to be in a place where you're just giving away tons of money to rent each month. It's good that Yuri has one roommate. Potentially he could move into a place where he has additional roommates, or it's just as long as you kind of maintain your housing budget and make sure that it's not too high above, or it's not taking up too much of your income. And then cars as well, right? If you don't need a car, don't buy one at this age. I think, if you can get away without using a car to travel, or if you do need a car, just buy something used and that's inexpensive until you have a higher income where it makes sense to get a better car. And then additionally, make sure you're matching, getting the minimum for your 401k match. Just contribute up to that company's match level. I actually don't think you should invest above the company match level. So once you've maxed that out, that's the percentage that you should allocate to it. Anything else, I think you can do better investing in a solid ETF or index fund, such as the ones above here. And then I'm using tech as the risk area for Yuri, but in reality, it would be better to actually diversify and pick stocks from multiple industries. So examples are pharma or finance, in addition to tech, and many other industries that are out there. Just making sure you're diversifying so that if there's a bubble in one of those industries, you're not losing a ton of money. So let's take a look at our next persona, which is middle-aged Martha. Again, remember, she's 35. She has $10,000 to invest, and she is planning for the future. So Martha is married with one child. She's a middle manager, let's say a senior manager at a large corporation. And most of her expenses are childcare related, right? So her child is fairly young. She has to pay for daycare, and her income is $75,000. So she's making decent money, but she has a child, and we all know children are expensive. So essentially what we're doing is we're taking the same strategy from Yuri, but we're reallocating the percentages to each category. So in growth, we're looking at 15% compounding, we're looking at a whopping 75%, and risk has come down to 10%. So let's look at the individual stocks for Martha. So I literally picked the same stocks, except for I added another line here, which is the individual dividends. So this is potentially just adding a little more weight to picking individual stocks that I believe are strong dividend growers and have paid out their dividend for a very long period of time. So most of these are like 50 plus years of paying out their dividends. They're called the dividend kings. So not just the aristocrats, but the dividend kings. So Johnson & Johnson, Altria, Procter & Gamble, and 3M. And that's really just a $500 amount. So again, if we remember her allocations, we've allocated 75% to compounding. So if you look throughout this middle section here, these are all either dividend funds, individual dividend stocks, or an index fund in the case of VOO. So that's really how the allocations have changed. The strategy isn't really that different, right? Martha's only 10 years older than Yuri, but she's starting to have more responsibilities along with more income. So let's look at some of the notes for Martha and see if you guys agree. Feel free to leave a comment below if you agree or disagree with some of these recommendations. So first, she should keep avoiding debt, right? So continue to pay off those student loans. Student loans typically have high interest, and pay off credit cards each month. Do not let those credit cards accumulate balances each month, because their interest rates are ridiculous, right? And that's where you can really run into trouble. So even if you're making a lot of money, if you have all of these expenses, then you should not be letting those balances sit on credit cards. Additionally, avoid increasing expenses with increasing income. So avoid things like expensive cars, expensive food, and expensive homes, right? This is where people can try to keep up with their neighbors or keep up with their friends on social media, and they'll be spending money that they don't really have, right? So you don't want to keep spending all of this money when you could be investing it instead. So try to keep the cars to a minimum, unless you have a absurdly large income. Cars are one of your biggest expenses. Try to pay that car with cash or a very low interest loan. Expensive food, obviously, like, Martha's married, so she's probably not getting out too much, and she has a new child, but you don't want to spend a ton on food. And same thing with your homes. Buy what you can afford. Don't try to be house poor, because that will actually eat away at all this money you could be investing instead. Also, at this age, it's important to use tax-free instruments, so things like HSAs, so health spending accounts, and tuition saving funds, where you can divert pre-tax money into those accounts and you don't have to pay taxes on them, and it is actually you're actually earning on that money as well. So remember, the theme is kind of making your money work for you. And then with tuition savings fund, you're also setting up your children for the future, right? Remember, Martha is planning for the future. And then most importantly, among these notes, is strategize for your future retirement now. So if you're at this age, you should be thinking about your retirement, whether that's in 20 years, 30 years, 40 years, whatever it might be. Start strategizing now. And the main thing is to invest consistently. So Martha has this $10,000 chunk she wants to invest now, but in reality, she should be investing every week or every 2 weeks. Whenever she gets paid, Martha should be putting some chunk of money towards her investments. Similar to Yuri, but usually at a younger age, you can't afford to do that, and there are going to be expenses that kind of come up, and you don't really have the income to have that buffer area. But at this age, once you're starting to hit middle age, I think it makes sense to invest consistently. Lastly, we're going to look at older Oliver. So remember, Oliver is 65 years old, has an amount to invest of $50,000, and he is ready to relax. So his background is he's retired from a job where he has received a pension and has health benefits. But he has a nest egg that he could invest or spend, which is that $50,000. And his income is also $50,000 a year from his pension. So his strategy is actually different from Yuri and Martha's, and that we've changed the categories around. And what Oliver is looking for is consistent income, right? Because he's retired. So he no longer has income other than his pension to rely on. And then compounding. So compounding is still important at this age. And then most importantly, safety, right? Or, second in importance is safety. So avoiding risk. This is really an age where you don't want to lose large chunks of money. And so you should be resistant to spending or investing in risky instruments. So, some recommendations. We still have the high yield VYM index or ETF on here at 25,000. So that's really the 50%. And why I chose the high yield ETF is because that is actually going to have a direct kind of cash flow, right? It's giving you consistent income, which is one of Oliver's primary concerns. That high yield, even though it's high yield, they're not extremely risky stocks. So that's the beauty of the ETF. But the yield rate is pretty high, and you can actually use that money and pull that money out. So normally, you would, if you're a younger age and you have VYM, you're typically reinvesting into either VYM or other dividend stocks. But in this case, Oliver can choose to actually receive some of that money, right? So at this age, you actually need some of that income, and so he can just directly benefit from that yield without reinvesting. Then I also included the Dividend Aristocrats and the Dividend Appreciation Fund, so Noble and VIG. These are kind of that middle bucket. You see it only totals up to $5,000, where you are still kind of working on compounding. So compounding is still important, right? Your 65 is getting younger and younger every day. People are living much longer than they used to, and so you still want to take the primary advantage of time, right? The best thing about investments, the best resource on your hand is time. So the more time you have, the better. And so even though Oliver is 65, he still has time. He's still going to be trying to earn money, making his money work for him. And then lastly, I have a bond fund here. So this is the safety category at 40%. So I chose the Vanguard Bond Index Fund. Vanguard short term, so BSV, that's 20,000, which is 40% of his allocation. And bonds are really a way to kind of just hopefully beat inflation. So you're outpacing inflation, but you're not having the huge risk associated with individual stocks. So that's how I allocated Oliver's money. Let's look at some of the notes here for him. So continue to resist the urge to spend, right? Do not go out and buy that recreational vehicle or sports car unless you really can afford it. You really have to take a look when you are ready to retire. You have to look at your finances and understand, can I live off of this for the rest of my life? And by taking a large chunk of money and dedicating it to a vehicle, which is a depreciating asset, right? It's not really an asset at all. You're going to lose out on a chunk of money that could be earning you more money through some other investment. So don't do it unless you can really afford it. Avoid risky investments. So we talked about this again, and avoid high variability stocks. So what you want to do is not focus on things that are constantly bouncing up and down, right? So I wouldn't invest in a lot of tech because that technology can be, unless they have a very strong moat, that technology can be blown up by another company or can go away very quickly, or something could be mismanaged in the company, and then all of a sudden you're losing large chunks of money. So just kind of avoid those kind of investments at this age. Potentially move somewhere with a lower cost of living or near family, right? So that can help you save some expenses, whether it's through not having to travel a ton because you're near family, or just the low cost of living in general. So this potentially means out of the country or into a state where there's no income tax, no state income tax. Keep those things in mind when you are trying to figure out where you want to end up after your retirement. Like we said, don't ignore compounding just because you're older. And then one last tip is to get a part-time job if you still want to work. At 65, again, people still have plenty of energy and are willing to work. So continue to do that, but just do it part-time. And especially if you need benefits, right? So if you can find a part-time job that has health benefits or some other type of benefits that you need, I would highly recommend you do that. So that's going to wrap it up for today's video. Hopefully you guys got something out of it. Remember, personal finance is personal. So make sure that you take what you can and learn from this video, but then apply it to your personal situation. Feel free to leave comments on other ETFs or other individual stocks that you guys think should be a part of this video. Hopefully you guys are continuing to consistently invest, and remember, time is on your side. So time is your biggest ally in becoming financially independent. So hit the subscribe button, hit the like button. I appreciate all my viewers out there. To you new viewers and returning viewers, thank you so much for watching, and I will see you again next week.